In today's video, we'll be looking at a double entry system for assets, liabilities, and capital. First, what is the double entry system? The system of double entry bookkeeping is a method of recording transactions in the books of accounts of a business. The double entry system states that for each transaction, there must be a debit entry and a credit entry. Preparing simple ledger accounts. A ledger account is a record of transactions affecting a particular aspect of the affairs of a business. Ledger accounts make use of a two-sided form that corresponds in shape to a letter T, and ledger accounts are sometimes referred to as T accounts. Here is a T account. At the top, you would put the title of the account. The left-hand side, that is this side of the T account, is referred to as the debit side. The right-hand side is referred to as the credit side. The debit side is abbreviated as DR, and the credit side is abbreviated as CR. Effects of transaction on accounts. So here we have the three real accounts: the asset, liability, and capital. So as assets increase, we debit. As assets decrease, you make a credit entry. As a liability increase, you make a credit entry. And as liability decrease, you make a debit entry. As capital increase, you make a credit entry. And as capital decreases, you make a debit entry. So the same rule that goes for liability also goes for capital. So again, as an asset increases, you debit. As assets decrease, you make a credit entry. As liability and capital increase, you make a credit entry. And as liabilities and capital decrease, you make a debit entry. Now we're going to record three transactions using the T account. Year 2018, on May 5, bought a motor van, $920 paying in cash. On May 8, bought office equipment on credit, $7,000 from J. Brown. And on May 9, invested $6,000 in the business bank account. So here we have some blank T accounts that we're going to use to record these transactions using the double entry system. So the first thing that we're going to do is that we're going to label our T account. There we have it. On the left hand side, it is labeled DR, which stands for the debit side. And on the right hand side, it is labeled CR, which stands for the credit side. Two accounts being affected on May 5 would be motor van and cash. So I'm going to go right ahead and underline motor van and cash. After identifying the two accounts that are affected, I now need to ask myself the question: are these accounts increasing or are they decreasing? After finding out if they are increasing or decreasing, I am going to put a small plus over the account that is increasing and a small minus over the account that is decreasing. And if the business bought a motor van, paying $920 in cash, this simply means that cash is coming out of the business in order to purchase this motor van. So cash would be going down. Cash is decreasing. So hence, I am going to place a small minus over cash. And a small point to note, all transactions must be looked at from the business perspective. So from the business point of view. So it is the business that bought a motor van paying in cash. So if the business bought a motor van, that simply means that motor van is increasing in the organization. So I'm going to put a small plus over motor van. The next thing I now need to do is to say how these items will be treated. But in order for me to do that, I now need to know what motor van is to the business and what cash is to the business. So how would we classify motor van? As an asset, or as a liability, or as capital? Motor van would be classified as an asset. So in this case, motor van is an asset, and as asset increases, because the plus right there represents increasing, so as an asset increases, the table says that we are to debit. So we are to make a debit entry because the asset is increasing. So I've made a note over motor van as to how it should be treated. So motor van is an asset and the asset is increasing. So we are to make a debit entry in the motor van account. So let me do that in the account. Here is my motor van account, and I am to come to the debit side of the motor van account. That's right over here, the DR side. And I am to make that entry because motor van is increasing. So I need to make a debit entry in the motor van account. I'm going to go ahead and write the date. So that's May 5. So after recording the date, I am now to put the detail. So the detail would be the other account in the very same transaction that is being affected as a result of the motor van being bought. In that case, it would be cash. So cash would go in the detail because cash is decreasing as a result of the motor van that was bought. So cash would be in the detail under motor van account. So now I have my date and the detail. So now the only thing that is left for me to record is the amount. And that was given in the transaction of $920. Here we have it. My T account for motor van is now complete. So there is the date, the name of the other account that is being affected in the same transaction, and the amount. So now we're going to go back to the transaction and see how cash is to be treated. So as was established earlier, cash is decreasing. In order for me to see how cash will be treated, I have to know what cash is. So how would I classify cash in the business? As an asset, as liability, or as capital? I would classify cash as an asset. So in this case, as an asset decreases, we are to credit. I'm going to go to the credit side of my cash account and I am going to make that entry just the same way as we would have done with the motor van account. So here is my cash account and I am supposed to make a credit entry in the cash account to show that cash was decreasing as a result of the motor van that was purchased. So I come to the right hand side of my T account now and I make that entry. After adding the date under the cash account, that's under the credit side of the cash account, I'm now going to add the detail. And the detail would be the other account in the very same transaction that was affected. And that would be the motor van. So the motor van would have resulted in the cash account decreasing in the business. So I need to put the motor van in the details section of cash account. So that's the cash account. We have the date, the detail, and the amount. So here are the two T accounts reflecting the first transaction that would have taken place in the business. So under the first T account, motor van, it has a debit entry. So the motor van account has a debit entry. And this is to show that motor van was increasing in the business, and this was as a result of cash being used to buy these. And under the cash account, this is showing that the cash in the business is decreasing. So cash in the business is going down, and this is as a result of cash being used to purchase or to buy motor van in the business. Right along into the second transaction, bought office equipment on credit $7,000 from J. Brown. The next thing we're going to do after reading the transaction is to identify the two accounts being affected. And when we say accounts being affected, we're referring to the accounts that are either increasing or decreasing. So that's the effect that we're talking about. So in this case, it would be office equipment and J. Brown. So let me just go ahead and underline those two items. So if the business bought office equipment, what is happening? This simply means that office equipment is increasing in the business. So again, we're going to place a small plus over office equipment, and then we need to figure out who J. Brown is to the business. Who is J. Brown to the business? The business bought office equipment from J. Brown on credit, so the business hasn't paid for it immediately. So this simply means that J. Brown is our creditor, or is the business's creditor or supplier. So that's a liability right there for the business, because the business owes J. Brown. And if J. Brown is a liability to the business and the business owes J. Brown, this simply means that the business's account with J. Brown would be increasing. So in order to say how these two will be treated, we need to say if they are assets, liability, or capital. So office equipment is indeed an asset, and as asset increases, we debit. And J. Brown is a liability to the business, and the business account with J. Brown would be increasing, so that's liability increases, and as a liability increases, we are supposed to make a credit entry. So now we're going to show these effects in the T account. We have two T accounts right here. So one would be the office equipment account and the other would be J. Brown account. So there we have it. So we now need to make a debit entry in our office equipment account to show that office equipment is an asset and it is increasing. So we need to come to the left hand side, so that's the debit side of the office equipment account, and make that entry. So remember, we're going to put the date first. Then in the details section, we're supposed to put the name of the other account in the transaction that is being affected, the name of the other account in the transaction that is increasing or decreasing as a result of office equipment being purchased. And then we would have the amount. So let's do that. So there we have it, our office equipment account. The entry has been correctly recorded. So on May 8, 2018, office equipment is increasing as a result of it being taken from J. Brown, which is our creditor. So now we need to make a credit entry in our liability account to show that our liability is increasing as a result of the office equipment that was taken on credit. So we need to come to the right hand side of J. Brown account and make that entry. Here we have it. The transaction is now correctly recorded in J. Brown account. So J. Brown again, it's a liability to the business because the business owes J. Brown. and the business owes J. Brown for office equipment that was taken on May 8th, amounting to $7,000. So the business owes J. Brown for these office equipment. So hence, we have to put it on the credit side of J. Brown account, because J. Brown is a liability account, and as liability increases, we are supposed to credit. And remember now, the rule for double entry says that in every transaction, one account must be debited and the other must be credited. So we can't have the two of them being on the debit side, and we can't have the two of them being recorded on the credit side. So now we are on to the final transaction. On May 9, the transaction reads, invested $6,000 in the business bank account. So now we are going to identify the two accounts that are being affected in this transaction. So it would be capital and bank. So you might be asking how capital and no capital is shown in this transaction. So the word invested would hence be the key word for capital. Because remember, capital is any investment that is made into the business by its owner. So any investment or anything used to start the business, it would be termed as capital. So the keyword invested there is referring to the capital account. So it would be capital and bank. We need to ask the question, if an investment was made in the business, what is happening to the capital account? It would be increasing because the owner invested $6,000. So capital would be going up. And as capital increases, we are supposed to make a credit entry. So money was invested. $6,000 was invested in the business bank account. So what is happening to the bank now, students or viewers? Bank would be increasing because the owner invested $6,000 in the business bank account. So that's $6,000 more in the business bank account. And remember, bank is an asset. So you see it as an asset in the business. Cash at bank, you see it as an asset in the business. So as asset increases, now we are to debit. So let's quickly write that above bank. There we have it. So now we're going to show this transaction in the T account. Again, one account must be credited and the other must be debited. So now we're going to record the transaction under the capital account. Should I come to the debit side and record that? If you're saying no, then you are indeed correct. We are to record it on the credit side to show that capital is increasing in the business. So we are to come to the credit side, that's the right-hand side of the T account, and make that entry. One of these T account would read capital account and the other would read bank account. We're going to put the date, the name of the other account being affected in the same transaction, that's in the details section, and then we're going to put the amount. The account now reads that bank account is increasing as a result of capital. So as a result of money being invested in the business on May 9, 2018. So just to close this video, be reminded that when using the double entry system to record transaction in the ledger account, so that's the T account, one of the accounts must be debited. So one must be recorded on the left hand side and the other must be credited. So it must be recorded under the right hand side. So thanks for watching. If there is any question, just go ahead and leave it in the comment section below.